Sam pulls up his charts. 10 seconds after his buddy texts him the same currency pair, same instant, different broker app on the other end of the couch. And the two numbers on their screens do not match. Not by much, a few pips, but enough that Sam starts wondering if his broker is ripping him off. Here is the uncomfortable truth. Neither price is wrong. In Forex, there is no single official price anywhere on Earth. Not one exchange, not one number everybody agrees on. That sounds broken until you understand why it is actually the whole design. Today we are taking apart the structure underneath every quote you will ever see, the ladder that runs from the biggest banks on the planet down to the app on Sam's phone. Once you see this ladder, you will never look at a quote the same way again. Start with something familiar, the stock market. On a lot of stock exchanges, one stock's price moves through a single gatekeeper called a specialist. Every buy order and every sell order for that stock funnels through this one desk, and the specialist's job is to match buyers with sellers while keeping a fair market. But that desk also has real power. If way more people want to buy than sell, the specialist can widen the gap between the buy price and the sell price, or nudge the quote itself just to manage that imbalance. One person, one screen, one price, everyone sees. Simple, centralized, and it works fine for stocks. So here is the real question. What happens to price when you remove that one gatekeeper completely? That is exactly what Forex does. Picture that specialist control room for a second. When buyers are piling in and sellers are scarce, the specialist does not just sit there. The spread, the gap between the price you can buy at and the price you can sell at, gets wider. That wider gap is the specialist quietly protecting the desk while the imbalance sorts itself out. It is not illegal, it is built into the job, but it means the price you see can shift because of order flow on that one desk, not just because of news or economics. That is the real problem with having a single gatekeeper. They can lean on the spread whenever it suits them. Now hold that thought, because Forex was built to remove exactly this kind of control. No single desk, no single spread to lean on. But removing the gatekeeper creates its own puzzle. Here is a myth worth killing right now. People assume Forex has an official price sitting somewhere, like a ticker on a wall in New York. It does not. Spot Forex trades over the counter, across a web of dealers and banks worldwide, with no central exchange sitting in the middle. Every dealer quotes their own bid and ask based on their own supply, demand, and risk. That is why Sam's price and his buddy's price were a few pips apart. They simply were not looking at the same source, because there is no single source to look at. Now here is the part that actually works in your favor. Because there is no monopoly gatekeeper, dealers have to fight hard for your business, and that fight means tighter spreads and better fills for you. But if every dealer quotes differently, how does the whole market avoid turning into chaos? That is where the ladder comes in. This is the FX ladder, and it is the single most useful picture in this video. At the very top sits the interbank market, the biggest banks on Earth, trading enormous size directly with each other, or through electronic broker networks. Below that sits a layer of brokers and liquidity providers packaging those interbank prices. At the bottom sits retail, you, me, Sam, trading through an online broker's app. Quotes flow down this ladder, and every tier marks the price up slightly for the service of access. Here is a pause and guess for you. Which tier do you think you are standing on when you click buy in your app? If you said the bottom rung, you are right, and that is completely fine. Everyone starts there. But notice this. Which tier you are on matters more than the number on your screen. Context beats the price every single time. So how does a price even get made at the top of that ladder? Big banks stream their buy and sell quotes into major electronic broking platforms, the interbank world's plumbing. Those platforms aggregate all the competing bank quotes and spit out a reference price, the number the rest of the ladder is built from. But here is the catch. Almost nobody outside a trading desk knows about. You cannot just log in and trade at that reference price. Access depends entirely on established credit relationships. A bank only trades with another bank, or lets a broker plug in if a credit line already exists between them. No credit, no seat at that table, no matter how much cash you have. That detail is the part that actually saves your account later, so keep it in the back of your mind. It comes back around when we talk about leverage. Down at the bottom rung, none of that credit gatekeeping applies to you, and that is exactly why retail Forex exploded. The internet and electronic trading knocked the barrier to entry down to almost nothing. Open an account, fund it with a few $100s, and you are plugged into the same currency pair the big banks trade, just through a broker sitting a few tiers above you. The tool that makes that small account matter is leverage, controlling a much bigger position than your actual cash would normally allow. Say Sam sees euro-dollar coiling tight under a recent high, and it finally pushes through on rising momentum. That is about as simple as setups get. Bullish, continuation, nothing exotic. His entry trigger is that breakout candle closing above the range. His stop goes just under the low of that same range, with a little wiggle room so normal noise does not shake him out. His target sits at twice what he is risking, a clean 2-to-1. Leverage is what lets his small account actually matter here, but leverage cuts both directions, and this setup can still fail. That stop is the only thing standing between a bad trade and a blown account. Small account, real market access, real leverage, this is the thing this whole video was building toward. Before we close out, let's look at this ladder in action on a live euro-dollar chart. Here's what I want you to actually do, not just hear. Pause this video, pull up your own broker's quote for euro-dollar, then pull up a second source, a different broker, a news terminal, anything, and compare the two prices side by side at the same second. Do not guess, go look. You will almost certainly find a small gap between them, sometimes a fraction of a pip, sometimes more depending on volatility and whose credit line is feeding whose feed. That gap is not a glitch. It is the ladder, live, right in front of you, proof that price here is a negotiation between dealers, not a fact broadcast from one exchange. Hunting for that gap, instead of staring at one candle, is how you actually feel what decentralized pricing means. Let's lock this in. There is no single gatekeeper setting the Forex price. That job belongs to competing dealers, not one specialist. Price flows down a tiered ladder. Interbank banks at the top, electronic broking platforms doing price discovery in the middle. Retail brokers at the bottom where you and I trade. Credit relationships gate who gets access to each rung above retail. Competition among all those dealers is what tightens your spread and gets you a fair fill. And leverage is what lets a small retail account stand on that bottom rung and still move real size, which is exactly why the stop, not the pattern, not the leverage, is what saves your account when a trade goes wrong. Here is the rule to write down. Amateurs chase the lowest price on the screen. Professionals chase the tightest risk on the trade. Remember Sam? Confused by two mismatched quotes? He was not being cheated. He was just looking at two different rungs of the same ladder, and now so are you. Next time we go one level deeper and break down exactly how a broker builds the price you see, tick by tick. Which pair are you watching right now? Drop it in the comments, and I will tell you where it usually sits on this ladder.